Hi, everyone, and welcome back. This is Wade into Wealth, and before we get into the meat and potatoes of today's episode, which is why dividends matter, I would like to recognize my nephew, son of Ethan, Griffin M. Wade, who graduated. Was it a graduation today? Not a graduation.
No, not
just,
really.
Moving on from his first year of
preschool.
preschool.
Yeah. Moving on up, he is. They gave out awards.
The Awesome Attitude Award, Awesomest Attitude Award, I believe.
Clearly comes from the Miller side of the family, not
That's how we know. It would have been the Grinch, Grouch, or Grumpy Award, and I would have said, "Oh yeah, he got that from you." But
thank you.
Yeah. So this goes hats off to Griffin, an avid hat wearer like myself.
Yeah, he wore that hat from day one all the way to the end.
Although I don't have a hat with my name on it.
No, but we can get you.
Yeah,
we can get
just
you
one that
for
says
sure.
Chaz.
Charlie. Charlie, your favorite.
If it says Charlie, yours is going to say Ian.
That's fair.
So, yeah.
Beauty of being brothers.
There's two names that we hate. Yep. I cannot stand Charlie, and I know you love when someone calls you Ian.
False.
Nathan doesn't bother you as much.
Basically, anything else doesn't bother me.
But Ian, no, don't call him Ian.
Doesn't work.
Doesn't
work for me.
All right. Well, so we're going to talk about dividends today and why they matter. And that sounds very simplified, but I was looking at a study the other day that was comparing a couple of indices and how they've done in 2022. Now, we're recording this on Thursday afternoon. It'll come out next week because you're heading on a well-deserved and much-needed vacation to Cape Cod. So
I'm excited to try a lobster roll.
Lobster roll.
I've never had one.
I don't know if I have or have not tried lobster. I can't remember. But you know what?
You can't remember. I feel like it's, I don't know. I know I've never had it, but most people love it.
Seafood is always better on one of the coasts.
Yep.
It's fresh. And where you're going, you can see them bring it right in off the boats. Pretty cool to watch. And, I implore you to take Daniel Tiger's advice, and you got to try new foods because it might taste good.
Yep. And if you got to go potty, just stop and go right away. You know what I don't get?
Flush and wash and be on your way.
That's right.
Those rhymes are important.
What I don't understand is Daniel Tiger's mom wears pants, but Daniel Tiger and his dad don't wear pants. I don't get it.
Mrs. Tiger wears the pants in the family. It's that simple.
I don't. It's often been confusing to me.
You can tell that we are the parents of children that skew younger in age.
And let me tell you, Daniel Tiger is solid in terms of helping to going to school.
Sure. Yeah.
Going to the potty. Trying new foods.
Mm-hmm. Well, they might taste good.
Anger.
Yeah.
Daniel Tiger knows what he's talking about.
Yeah. Well, he's based on like
Mr. Rogers.
So,
yeah, it's really good.
Daniel Tiger, not great in person at the Strong Museum of Play, if I remember.
Frightened Griffin. Scared Griffin.
Did not love it.
He's not great with those large-headed things.
Although, and if I remember June, and I met you there, Charlotte was out of town with Liz for something, and June saying afterwards that she did not have fun.
Yeah.
And she was not going back.
She was over it.
Not going back to that
over
again.
For sure.
She was
a good sport.
She was a little fed up to have waited in line and then have Griffin not want to see him, but I get it. It was a creepy head. So
too big.
Yeah.
And for social distancing purposes, the person has a mask on, yet they put up a small white picket fence and you cannot get close.
To a mascot.
Yep.
It was a mascot, right.
Okay. Mascots have COVID.
I don't know.
Never know.
I don't know.
But
I don't know.
Either way.
Let's get this train back on
Strong
the rails.
Museum of Play, a good gem here in Rochester.
Sure is. Yep, sure is.
Back to dividends.
So what I was looking at is, the markets have struggled this year. And I was saying we're recording this on Thursday. Look, the markets
May 26th.
will be different when this comes out on Wednesday, June 1st. But still likely to be down somewhat on the year.
June 1st.
Yeah. So what we're looking at is
still likely to be down by June 1st.
Yeah. Still likely to be down.
I'd love for that to change. That'd be a heck of a move.
We'll see. My gut says it'll still be down. So,
we'll see.
But looking at the performance of what's called the S&P 500 High Dividend Index, which is basically a grouping of companies that pay high or higher than average dividends, versus the S&P 500 Buyback Index, which is these are groups of companies that don't necessarily have a focus on dividends, but that have recently focused on buying back their stock. And the question is, well, what would you rather have now? Would you rather have cash from a company, or companies that use cash to buy stock back, which may, at least in the short term, cause prices to rise.
And why would it? Because the purpose of buying the shares back is to take them out of the marketplace. So if there are less shares for a similar sized company doing the same amount of business, theoretically, that should push the share price higher.
In theory.
We've also seen that sometimes that can change certain multiples that can help get bonuses paid to high-level executives. Mm-hmm. So it doesn't mean that it's bad, doesn't mean that it's great, but you're a company, you've got $1 left over. Do you pay it out to everybody who owns the company? Or do you try to buy back some shares and hopefully stock. The shareholders can see some appreciation in the price of their shares that they continue to keep? That is the question.
We've never been a huge fan, you and I have not, of share buybacks.
Well, and that largely comes from our tutoring under George Conboy, the chairman of a firm who does not care for share, and rightfully so.
Right, and we've gone on to form our own opinions of these things. But and so here's a great example why. How are they doing year to date? The high dividend index is actually positive, almost 4% this year. So that is companies like Exxon, Chevron, AT&T, utility companies. If you own those companies, they've done fairly well, and you're probably fairly happy that you do. The S&P buyback index doesn't own a lot of those companies, more so companies that don't really pay dividends. That's down 13% on the year. So the point of this is it's an
illustration. Which is still less than the market.
Right.
It's not terrible.
Not terrible. But when you're looking at the two of them, one stands out. And the point of this is not necessarily to compare two indexes, but to get into the conversation of what do you prefer as an investor? A company that has an eye on returning cash to shareholders, and also the value of dividends in periods of turbulence in the markets.
Sure.
In which we are in one right now.
Well, if we go a step further, it would also be fair to say that we don't have the statistics in front of us, but the high dividend index probably vastly underperformed the stock buyback dividend index in the couple of years leading up to this year, 2020, 2019, 2018. Well, 2018 was a down year, but 2017 before
when the markets are really rising significantly, companies companies that would be in that index have outperformed.
So we look at it in a very short-term vacuum, but taking it in the sense of a lot of market volatility so far for the first 5 months of this year, and why would a dividend portfolio be faring better than, in some cases, it may be fair that some buyback indices may be focused on a little bit more growth-oriented companies, possibly. But why would a dividend company be faring better in a time of market volatility? Well, it stems to what type of companies can pay dividends. Typically, they need to be, well, especially high dividends, they need to be stable and more mature type of businesses that have consistent earnings and revenue from the operations that they have. So those types of companies, when the proverbial crap hits the fan, tends to fare a little bit better. You will also see investors shift from more aggressive companies to companies that are a little more boring because they want to have the confidence that we're going through this really choppy and challenging time with markets. I would really like to own the Procter & Gamble's of the world, the General Mills of the world, the Exxon Mobil's of the world, more so than the high-flying technology companies as risk investments start to take a little bit more dip.
Rarely do higher dividend payers beat the market when the market's going well.
Correct. But the reverse is true.
Right, it is. But typically when the market is doing well, dividend-paying companies still do just fine.
Yeah.
Nobody is complaining and saying, oh, look how bad that did. It's just they typically are a lot slower because the growth has already happened.
Yep.
The fast growth, the exponential growth that you might see has already happened. In many cases, as you said, they offer stability, but they offer income, which is another really important part. And I'd say right now, one of the reasons that dividend-paying companies are even more in demand is because of inflation. And the fact that everything costs more. And so if you have a company that is willing to pay you cash, especially a higher rate of cash, That's something that a lot of people like.
Well, not only that, but the prospect of companies that have a proven track record of increasing their dividends
Yep.
on an annual basis often and historically has been a very good hedge against inflationary pressures.
Well, think about it. When you're in retirement, in many cases, it's the only hedge.
Yeah.
Unless you're working. If you're not working, now even if you are working, think about the typical sources of income that most people have. Perhaps you have a part-time job in retirement or early on. You have Social Security. Anytime Social Security goes up, it's only because inflation has gone up.
Correct. It's tied to the consumer price index.
Right.
So the only way your Social Security is going up is if all your bills went up too.
If you own fixed income investments, bonds and preferred stocks, things like that, typically that interest is fixed. Almost always that interest is going to be fixed.
Hence the name fixed
income. Right. It does make sense. Now,
Yes.
when you look at, what about dividend paying companies? Procter & Gamble's an example. Johnson & Johnson is another one. None of these are recommendations to buy them, but they're examples. Target is another one that has increased its dividend for over 30 years. RPM International, maker of Rust-Oleum paint, is over 45 years. They've increased their dividends. These are the companies. That is how you have a portfolio that generates income that increases on a regular basis. And a lot of those companies are still increasing their dividends at 8, 9, 10%
Right.
a year, which is a significant increase in income.
And in retirement, you want a growing stream of income because your bills aren't going to go down.
Mm-hmm.
When's the last time anybody's property taxes went down?
Well, I mean, we do live in the county with the highest property tax rate in the United States. So certainly not here.
Not anywhere.
Not anywhere, but
Anywhere.
yes, not anywhere.
Your bills are always going up. Therefore, it's important that you have an income stream that is going up along with that and allowing you to maintain your purchasing power. But whether you should own dividends or not, I think largely comes down to what your strategy is.
Mm-hmm.
Because if you're working and you're what we call an A to B investor, you're at point A and you want to get to point B, which is retirement, and you want to build up that nest egg, well, you can make a case that more growth-oriented investments,
Sure.
which pay less in dividends, is a better fit for you. Once you make that transition from being an A to B investor and you get into retirement, you become an income investor.
Mm-hmm.
Because you need to turn on the income faucet from your investments. Of you have this pot of money now, and how does that help you start paying your bills now that you aren't getting a paycheck every 2 weeks? And dividend companies can be a key component to helping accomplish those goals.
Yeah. Another example, you want to buy low and sell high? One of the only ways to do it, reinvest your dividends.
Mm-hmm. Consistently over time, yeah.
And, we have clients that we've worked with for a long enough period of time that when you go look at a position that someone owns and look at all the dividend reinvestments, the line, it's just an incredibly long list.
Every printer's nightmare.
It truly is. But that is another way that people create and generate wealth over time.
Absolutely.
So let's flip it over, though, because we've talked about why dividends are so important, and they are. Where can it get problematic? Where are some of the spots we need to be aware of when you're looking to invest in companies that generate income and dividends?
We have a jargon term called chasing yield. What it means is just going after companies that pay really, really high dividends. 8, 9, 10, 11, 12%.
Ooh.
On paper, it sounds great. I can get a 10% dividend. That's fantastic. You would probably agree with me that when we see something like that, our first thought is, how in the world are you paying for that?
Mm-hmm.
And for how long can you pay that for? Because it becomes a real concern. You have to have meaningful earnings and real growth in your business to be able to feasibly and sustainably pay more than 10% or pay more than 7, 8, 9, 10% in a dividend.
Right.
And that's where I think we see investors most often get into trouble when they try to get the companies that pay the highest dividends.
I'm going to share an anecdote. When I was starting in this business and cold calling, which works. It does work to try to find clients and build my business. There was one gentleman I called who I remember two things. He was blind, and he said he didn't have a ride to come meet with me. I said, that's okay. I'll come pick you up. So I went in my beat-up Jeep that I had at the time, picked him up, although he was blind, so he didn't know it was beat up, and he came down to the
Outside
office.
of the noise of the muffler, he probably
That's
thought
true.
he was in a Porsche.
We looked at the end. We looked at his investments, and he had real estate investment trusts that
well,
were
you
all
looked
paying.
at his investments.
Yes, that were all paying over 11%. They were all paying over 11%. And I remember saying, there's a lot of risk in this portfolio. And he's like, yeah, but I'm looking at all this income I'm getting. And we were in a period of time where interest rates were really low, so they were doing okay.
Right.
And, we met, we had a nice conversation, and nothing really ever came of it. I called him, I don't know, a couple years later, a couple months later, but it was a period where interest rates had risen a bit, market was pretty choppy, and I remember him saying, well, I don't have as much as I had when we talked last time. And the reason was those investments typically do okay when everything's going okay, but as soon as there is trouble in the water, they get hurt.
Mm-hmm.
They get hit, and you get hit hard.
Yeah.
Those are the investments that you can see a loss of 25, 30, 40% in a day.
And
when
we have
something
to
happens.
we have to remember that you get compensated for the risk that you take.
Mm-hmm.
If the 10-year Treasury, which is kind of a baseline, risk-free rate considered, meaning without taking much risk over 10 years, you borrow from the U.S. government and you can get
2.7% right now.
Right. If an investment is paying you 11% in a dividend or an interest rate, that tells you that you have what's called 8% worth of credit risk. Credit risk meaning the risk of the financial stability of the specific company or investment that you're investing into. So 8% above and beyond what's considered the risk-free rate tells you that you're taking some real risk in that investment. And as long as you're comfortable with that and okay. But I think a lot of people go into it and think, I'm going to get 10% dividend. This is going to be great. And don't think about the downside that a company or an investment carrying that much risk can provide.
When all else fails, ask yourself the basic question, and it really holds true. Does this sound or seem too good to be true? Because if it does, it probably is.
You're right, Charlie.
Thank you, Ian. So dividends matter.
Especially in times of volatility.
They do.
Which, let's face it, when you're retired, eking out every bit of percentage on the upside probably isn't as important as making sure that you have more protection on the downside when markets hit challenging times.
No, but let's think about this, because that brought up a thought. How many conversations have you had recently with folks where, everyone's account or investments are down at the moment, where you've been able to say, look at this group of investments and it's dividend-paying companies, and we're not worried about those. Those are okay. Those are fine. It's a lot easier when we're in a period of turbulence or choppy waters within the markets. It's a lot easier when you've got companies that are spinning off some cash and that are mature enough that you can look at them and say, these guys are okay. They're making a product or selling a good or service that people still know and use. They're still earning money. They're still generating profits, and they're still paying cash back to you. It's a lot easier to navigate this when you have investments like that than you're saying, well, we need the share price to turn around.
That's why it's important to have a general idea of what you own. Because when you're going through the challenging times, the number one thing that you can't do is succumb to the fear and the anxiety that comes with it, because that's a decision you will regret 10, 15, 20 years later. And understanding the investments that you have and looking and seeing that, well, we use their products, we use their services all the time, and they're not going out of business. If that allows you to hold on to your investments during these tough times, it's worth itself in spades so that you don't regret that decision 10 years from now.
Sure is. There's a saying that I heard from Chris Hout, who was a guest on our podcast last summer when we talked about the Olympics, that anxiety equals fear plus uncertainty. When we're in a period like this, where there is fear and concern in the markets, having companies that are paying and increasing their dividends on a consistent basis can help reduce some of that uncertainty or some of that fear about how these investments are going to do, and therefore help reduce some of that anxiety that it's hard to not feel during these periods of time. Well, you're going on vacation, so you get out of here and enjoy the Cape. It's a lovely place, and I'm interested to hear how that lobster roll is for you.
And unlike Daniel Tiger, we will wear pants.
Thank you.
Yep.
We all thank you.
Yeah. Yep.
And on that note, Wade into Wealth will return next week.